All right. Good afternoon. Thanks everybody for joining us. We're really excited to spend the next hour with you. We have clients that have worked with us for a few months on the call, and we have clients that have worked with us for 30 plus years. And we have people joining from Ohio and California and everybody, everywhere in between. So really appreciate your time. I'm Brian. I think everybody knows Josh. All the way to my right is Colin White, who's our portfolio manager, and I know new to many of you. Thanks again for being clients of Frazier Financial.
So before we get into the meat of the presentation, we wanted to take a brief moment and talk about stock market corrections. And you may feel like that's a little odd, given that the market is at all-time highs, things are going well. But the reason we want to talk about that right now is that it reminds me of one of my favorite stories that relates to investing. And it's about when you get on an airplane and you're on the airplane, you're boarding, you put your podcast in, you get your book out, you're sitting in your seat. You've been on an airplane a ton of times. You're not listening to the safety demonstration from the flight attendants. And then all of a sudden you get up in the air and you feel some bumps. And you kind of wish you could go back and re-listen to that demonstration. Where are the life jackets? Where are the exits? How do I do these oxygen mask things? And so the reason we bring this up now is it's a lot better to talk about bad markets before they happen. And right now, everything's great. Markets are up. Almost every asset class we're invested in is firing on all cylinders. So it may feel odd to talk about market corrections now, but the science has shown us that when we're upset about the market, the frontal cortex, the part of your brain that does your high-level thinking, does not want to work. And you're thinking with your fight or flight amygdala, right, Colin?
Amygdala, yeah.
You're thinking with that part of your brain. And so when we come to you and we say, the markets are down, your accounts are down, here's all these great things we're doing for you, your brain is not going to want to think about that. It's going to be upset and it's going to want to pull the plug or sell or do something different. So part of this story right now is just to remind people, we do think about markets going down. We try to prepare for them. We do have a plan if they do. And now is the time to talk about it while we're not emotional and the markets are actually up. So probably not how you expected this call to start, but we just want to bring that up. I'll kick it back to Brian.
For those of you that are fans of The Office and Michael Scott, that's a GIF on the side of your screen. That's not real. And that's not a quote from us. We wanted to highlight how bad predictions and headlines can be. So that's why we're starting with this screen. Those are all real headlines from very reputable news sources. And really none of them came true. Couple of housekeeping things for everyone. We do have a Q&A tool. And so if you're new to Zoom, it would be at the bottom of your screen. We would love for you to ask questions while we're going. I'm going to be reading all the questions and we can interject and hopefully have this be interactive. Everyone is on mute and you'll stay that way. That just prevents anyone's dog or vacuum cleaner from keeping anyone else from hearing. If you really have some sort of tech issue or Uber Eats certificate issue, you can call the office and ask for Carrie. She's on call for tech support. We're not going to have a replay available. I know that's a common question. There's quite a few hurdles for compliance to get a replay approved, but we're going to work on doing that with some future webinars. So with that, jump into your guys' presentation.
So topics, we've got some prepared information to share. We've got things on Trump 2.0, the overall markets, how we see them. We've got things on Bitcoin. I know we get a lot of questions on Bitcoin. And also, lastly, we've got some information on how we position portfolios right now. So we can go ahead and dive into that. Colin, you have anything to add right now?
We're also going to talk a little bit about some concentration in the market. That's a talking point now. So kind of give some details on that and talk about that. So
awesome. So 2024, obviously, a new calendar year has rolled around. Very natural to kind of look at how 2024 went and what do we expect in 2025. What our clients have hopefully gathered from us is that we have a ton of humility. We don't think we can predict with a lot of precision what's going to happen in the markets. Some of the smartest investors in the world that we'll put up on the screen here in a minute, they have PhDs and economists and people on Wall Street trying to predict what's going to happen to the markets. And the reality is nobody really knows. But there will almost certainly be bumps along the road. And you can see this chart goes back to the 1970s. It says markets have rewarded discipline, and that's 100% true. And there's all sorts of scary things that have happened and reasons to panic, reasons to sell. but the markets are pretty resilient. Companies find ways to make money. They find ways to create products and services that people want to buy. And despite a lot of the scary stuff that happens, most investors are rewarded by staying the course. So as far as 2024, a great year for the US stock market, up double digits. Other stock markets outside the US were positive, didn't quite keep up with the US, but still positive results. Something that we love that's returned to the market in the last couple of years are yields on bonds. So now we have the ability to actually earn 4, 5, 6% return in bonds, which we haven't been able to say that for 15 plus years. So if you're a retired client or a more conservative investor, that 30 or 40% of your portfolio that's in bonds, we haven't felt this good about the yield opportunities in probably 15 plus years. So that's all good news. Brian, can I run through a few more slides on market predictions? This is just unique to 2024. Some of the recaps on what happened. We had a presidential election. That was obviously the big news. Inflation is somewhat moderating. So inflation got up to 8, 9%. It's kind of been sticky at 3%. Prior to the pandemic, we had 2% inflation, almost like clockwork for a really long time. And now we've been at north of 3% for several years. So markets are kind of grappling with how we adjust to that inflation. A lot of clients are probably asking, when are my prices going to come down? So when are my eggs going to be, $5 a dozen instead of $8 a dozen for organic eggs? And inflation we're not going to likely have deflation. So prices will hopefully stop going up, but it's not like we're going to return the prices that we saw in 2019, unfortunately.
Yeah, to kind of hit on this slide a little bit more, this chart shows the return this year and the reasons to sell. There's a lot of geopolitical uncertainty, some tensions in the Middle East, a lot of issues in the US, talks of the Trump presidency. As you can see, the markets did still return positive numbers this year. So kind of weathers that storm and kind of look past the day-to-day headlines.
It's really tempting to always talk about the US stock market because that's what you see when you look at the news channels. We talk about the Dow Industrial Average, you talk about the S&P 500. But when we're looking at portfolio opportunities and how to invest, that's just a small section of what we think is a smart investment. So we do have a bunch of investments in the US. We do own the S&P 500 style funds. So we do own Microsoft, NVIDIA, all those big companies, but we own a lot of other things too. And the reason we do that is the US stock market has performed well over long periods of time, but it has hiccups, and a 15% correction is common. And you hear a 15% correction, that's $1 million turning into 850,000. So that's the normal correction we get every year, which can be hard to stomach for some folks. So when we add other things to the portfolio, like bonds, real estate, stocks outside the US, maybe some gold, that really dampens the volatility, helps reduce some of our stock market, being whipsawed up and down.
So what people see on the news is not going to be.
It's not the whole portfolio.
Yeah, it's not what
part of it.
Jim Cramer is only talking about one little block of that orange circle. Yeah.
And from a sizing standpoint, we kind of thought this was fascinating that if you look at what is investable, the bond market is bigger than the stock market. Real estate is a $130 trillion asset class. Is that right, Colin?
Yeah, just
With
single
a T.
family. Yeah.
So there's just a lot of things to invest in that aren't stocks. But again, stocks are a great thing to invest in the long term, but we like to kind of create a cockroach portfolio that hopefully you can't kill it because it has gold, it has inflation protected bonds, it has stocks, it has bonds, even commodities. So that would be, oil, wheat, all sorts of other commodities that are very sensitive to inflation. Some of you have seen this chart before. Trying to time the market, meaning let's get in, let's get out, is almost impossible. You have to be right when to get out, and you have to be right again when to get back in. Nobody has really been able to show that they can do that long term. So time in the market is what has rewarded investors. And the next slide will show long-term returns for stocks. Some clients see this and they say, great, small cap stocks have been the best over a long period of time. Let's just put all of our money in small cap stocks. The reality is you just have a lot of volatility. You would have minus 20 and 30% events with relative frequency. And when I say long-term can mean 10 years. So the market can go down and stay down for years on end. And we've had lost decades in the US. We've had multiple decades where the market didn't do a whole lot. So 2000 to 2010, the US stock market was almost flat for 10 years. Our clients were up about 5% per year during that time frame because we had stocks outside the US, we had bonds, we diversified. So the diversification really can show when the US stock market is disappointing.
Your helper's not fast enough there.
You've heard me say before that the economic summers in the US are way longer than the economic winters. Graphically, the red squares and rectangles are, the market drawdowns. And the blue is the expansionary period. So the average bull market is much longer than the average bear market. And the average bull market gives a lot more returns than what is lost in the bad times. So if you're patient, you can make money with your stomach, not your brain in the market. And that whole time in the market concept is shown here. Back to how bad forecasting can be. The middle chart, that's 2024. So Wells Fargo, Morgan Stanley, JP Morgan all thought we were going to have a minus year for the stock market in 2024. We were actually double-digit positive. On 2023, it was just as bad. So you have big investors saying we're going to be flat. UBS said barely any gains. Citigroup pretty much flat. Market in 2023 was up over 20%. So predictions are really hard. I think Yogi Berra said predictions are really hard, especially about the future. So we don't try to predict the market, but we do want to prepare for a variety of different outcomes. Paul, anything to add there?
So internally, we've kind of looked at a big forecast with a lot of serious hardcore math that we put into it. We looked at high, low, and average returns with data back to the early 1900s. And the framework we are using is the 8 years when Ohio State won a national championship. The average stock market return was positive 12% that year, the S&P 500. The low was down 11%, and the high was positive 38% in 1958. So our question is, what's the stock market going to do in 2025? That kind of emphasizes that, we have good as an opportunity to forecast what it will do when Ohio State wins, as any of these professionals do, with all their data and resources. So
I believe that stat came from our founder, Jim Frazier.
Yeah. He sent it to me this morning.
Jim phoned that in quite
So politics, this is a really big conversation point for our clients. I started here in 2007, and obviously the President Obama became president. 2008 financial crisis was occurring. And so going through these different political cycles, I've noticed that my clients who are left-leaning politically, they felt really good about the Biden administration. They felt good when President Obama was in office, and they are not a big fan of Donald Trump and really worried about what he's going to do to the economy. My right-wing clients, everything's the opposite. And politics are so powerful to our emotions. They really become something that people are really worried about. So you can look at the polarization in Congress. People are more polarized between the left and the right. Something that's fascinating to me is consumer confidence. If you're a Republican, consumer confidence went way up after Trump got elected. And if you're a left-leaning person, your confidence went way down. Inflation expectations for Democrats went up when Trump got elected and down when Donald Trump was elected. So your political viewpoint has a really strong carry through to how you feel about the economy. So what we try to do with clients is realize people have strong views on this. And when you have someone like President Trump, who's a polarizing figure, we're trying to look, dispassionately at what his proposals are. And so most people would agree that he's pro-business. He wants to grow the economy. He wants to decrease regulations. But all those good things we think could help markets, but there's also things that he may do that could cause markets to have concerns. So all the past administrations that we can remember, they just want to spend money. So we're spending a lot of money that we don't have. And that would have occurred if we had a President Harris or a President Trump. So the money printing and the money spending is concerning for the market. And tariffs are a big thing that President Trump is using to implement his agenda. We had a first term with President Trump, and the markets, I think, were much more worried and adjusting to his style in his first term. So we had tweets, people getting fired by tweets, or on Truth Social now. We had new policies getting unveiled at 1 o'clock in the morning on Twitter. The markets weren't used to the president doing that. But towards the end of his term, The tweets weren't really disrupting the markets nearly as much. People got used to that. Okay, that's how he governs. If he says he's going to take over the Panama Canal or Greenland, that doesn't mean he's going to do it the next day. That's his negotiation style. So I've heard a lot of people trying to dig into what Trump is thinking. They've read his book, The Art of the Deal. They realize that he really tries to redraw the lines in a discussion, threatening 100% tariffs on China, where really likely only going to settle in at a certain percentage. So during the first term, there were tariffs, a lot more tariffs than what had normally been implemented. But once the market adjusted to it, it was not the end of the world. So I do think the tariffs will move markets a little bit in China, perhaps in Canada or Mexico, depending on who he's targeting. Parts of the European economy could be hit with tariffs. But I don't think that that's what's going to cause significant volatility in the market because we're all talking about it. It's the things that we're not talking about that typically surprise the market. So I just don't see tariffs as being one of those things that's a long-term issue. If he tweets out tomorrow that there's a blanket 60% tariffs on Chinese goods, you're definitely going to see volatility in the Chinese stock market. But if you go back to his first term, the tariffs were not a huge percentage of our trade. And likewise, tariffs are revenue to the government. So the government needs revenue. So most left-leaning people say we should raise taxes or we need additional revenue sources. Well, the tariffs are going to do that. So it's basically a national sales tax that people don't think they're paying, but they actually are. And there's debate amongst economists on how these tariffs actually work. So there are economists that say they're inflationary. And then there's some economists that say, yeah, they're inflationary the first year, but they're actually deflationary later on because they're bad for the economy and they slow the economy down. So there's a give and take on this. I wouldn't say it's so black and white that tariffs are good or bad, but I do think that we're going to have to get used to them. JP Morgan put out a report that showed the tariff reciprocity line for the United States in every major economy. And every single economy has higher tariffs on our goods than we do on theirs. So right now, the US has just been in a position where we're letting other countries have tariffs on our goods, and we've decided not to really fight back. And Trump is deciding to fight back a little bit. And we don't have a dog in the fight. I'm not saying that tariffs are good or bad. We know they exist, and we do take them into account when we're looking at investments. Trump's also inheriting a way different economy. So interest rates are higher than when he first got elected. We have a lot more debt. Our national debt is higher. So his ability to cut taxes, especially at the corporate level, is probably a little more muted than it was when he first got in. So he's going to have a different economy to be working with. But we love all these slides that show that whoever's in the office, whether Republican or Democrat, there's really not a statistically significant difference in returns. So you can't say when there's a Republican president, the market does great, and when there's a Democrat president, it doesn't. There's just so many exogenous things that happen. If you look at Trump's first term, COVID happened at the end of his term. The biggest, economic disruption in modern history. That had nothing to do really with Trump, but he's going to have credit for those bad stock market returns the last year or two he's in office. Same thing with President Bush. He comes in office, you have 9/11, the tech bubble burst. President Obama takes over in the middle of the financial crisis. So the market is bottoming at that time and then recovering. So there's just a lot of things that happen that the president doesn't have control over.
Yeah, I think it's important that, it is natural to feel as if there's a connection between who's in the White House and what the stock market's going to return that year. But we really try to emphasize that we don't want to let political ideology become any basis for investment decisions and to kind of stay the course. And this chart shows well that regardless of who's in office, that the S&P 500 has returned positive over the years.
That's the last slide around politics. So I'm just going to hit pause. We haven't had any questions on politics, which is shocking. And
we had one big email ahead of time around tariffs and inflation. The tariffs, if tariffs are substantial, then I think we obviously have more revenue coming in, and it could be inflationary for consumers. So what we have done is we've added an inflation protected bond fund to all of our investment accounts. So if we do have unexpectedly high inflation, we've addressed that very specifically. So we have that bond fund that has inflation protection in there just because we are worried about inflation staying high or getting higher. So like we said, we can't predict where inflation is going, but we can prepare. So if we can add an investment that can do well during inflationary times, we want that, and we have done.
Yes, ready to move on to bonds? Josh previewed it.
So I had to educate Colin on where's the beef. he was not familiar with this concept. But for the last almost 20 years, there's been no beef in the bond market. So this busy chart, the purple lines are where yields have been on bonds the last 10 years on average. And the blue diamonds, not triangles, but diamonds, that is where the yields are today. So all the blue diamonds are higher than the purple. There's just yield to be had, which is great. It's great for people who have investment accounts because they're earning interest on their money. It's not so great for younger people trying to buy a house or finance a car. So if you're retired and you have money saved up, that's why we love having some money in bonds, because you're going to be able to get these 4 to 6% yields. And even 8% is not unheard of in the bond world. One of our bond funds was up 10% last year. So you can make money in the bond world and almost compete with stocks. And as far as the competition with stocks, if yields go much higher from where they are right now, that would likely be bad for the stock market, because the stock and market investors are looking at what they can get in cash and bonds. And so historically, if stocks have done 8 to 10%, it's still exciting enough to get 8 to 10% in bonds, or sorry, in stocks versus 4 or 5% in bonds. But if yields say were 6, 7, 8, 9%, then all of a sudden the stock market looks a little less attractive. So I think we're in somewhat of a sweet spot. The market's okay with where rates are today. But if for some reason interest rates went up 1 or 2% from here, I don't think that would be great for the US stock market. So the whole other reason why to be diversified and not own only US stocks.
I would also emphasize that this chart on the right, which shows what our bonds are producing as income, 2 years ago looked completely different. So the yields are significantly lower, close to 1%. And now that 20 to 40% of a client's portfolio is actually generating income. So we're super, super excited about that 5+% of that 20 to 40% of a portfolio is something to be excited about.
All right, concentration risk in the US stock market. The S&P 500 index is a common index that people use to look at the stock market. It's made up of mostly the 500 biggest companies in the US. And historically, the top 10 stocks have made up 20 to 25% of the index. Right now, that's sitting at almost 40%. So what that means is we have a handful of really big companies that are kind of driving what the market is showing from an index return standpoint. We love to be diversified, right? You hear, don't put all your eggs in one basket. We also don't want to put all your eggs in 2 baskets. So we don't love that the market is so concentrated with these 10 big companies. Now, they're wonderful companies. It's Microsoft, NVIDIA, Amazon, Tesla. And we always have to remind ourselves that a great company isn't necessarily a great stock to invest in. And what comes with high stock prices are expectations. So if you look at the Ohio State Buckeyes, and we're talking about Ohio State a lot in this call because we're in Columbus, we just won the national championship. Everybody's still really excited about that. But when Ohio State lost to Michigan this year, the whole town turned on Ryan Day, the coach, the team. His kids couldn't even go to school because they were so scary. Now everyone's all mad. And why is that? It's because expectations were so high for this team. They have a great roster. They have so much money to give in the NIL. It's like $20 million we're paying these players. So, but that's what happens to stocks. When too much good news gets baked in, it gets really hard for these companies to meet those standards. And so history is littered with this happening where the market gets too concentrated. Another way to look at this, the last time we just looked at was the top 10 stocks in the S&P 500. This is the top 5 stocks in the S&P 500. So we've seen this movie before. You got to go back to the 1960s. Colin learned about the Fab Five recently. So we've got them in there.
We have a Michigan logo and not an Ohio State logo.
Well, that's because we're saying that this is a bad thing. So if you look at 1964, top 5 stocks, AT&T, General Motors, Exxon, IBM, Texaco, all great companies. The problem is their share prices got ahead of what their actual businesses could produce. Mm-hmm. And 4 out of those 5 companies had double-digit negative returns the next 3 and 5 years. Yeah. So am I saying that NVIDIA, Apple, Amazon, Alphabet are going to have minus 20 or 30% years? No, we don't think we can predict that. However, every time a new technology comes around, it's common for the market to get a little too excited. and around AI, data centers, that could be occurring right now. And we would like to own less of that. Not none of it, but less of it. We also think that there's a picks and shovels approach. So if you think about the gold rush, do you want to be a gold miner or do you want to be selling the picks and shovels? We would like to own a little bit more of the picks and shovels around AI than maybe the companies that have, all the good news baked into their share prices. And the market in the tech bubble in the US in the late 90s got really excited about the internet. And we talked about internet companies. Now nobody would call something an internet company. The internet is it's part of everybody's business. So AI could be the same thing. We may not even be talking about AI companies in 10 years. We could just be saying, no, every business uses AI. So tech bubble, NASDAQ went down 80%. It took 12 years to recover. I'm not saying that's going to happen in the markets right now, but it's not without precedent. If you want to go way back in history, 1857, first global recession triggered by a stock market bubble. And it was started with Ohio railroad stocks, 1857. So the new technology at the time was railroads. People got over their skis on valuations of railroad companies. Banks in the US started failing. In Ohio, we had a life insurance company, the bank failed, that trickled over to New York City. It actually went over to Scotland. In London, you had bank failures, all triggered by what started in Ohio. And it was enabled by another new technology, the telegraph. So we don't necessarily think that's not going to happen, but it is a risk. And so if we can own stocks that we think are going to perform better, then that's what we've chosen to do and help reduce risk.
I would also emphasize on this point that not only is the market concentrated within these top 5 names, but these top 5 names are also very intertwined. So there's a statistic out there that over half of NVIDIA's revenue comes from this other Mag 7 stock. So not only is the S&P concentrated in these 5 names, but they're also concentrated within each other too.
All right, Colin, talk about some breadth in the market.
Yeah.
Bread.
That's pretty bad.
Yeah. So this slide goes to show that on the side we have over a 5-year basis, Texas Roadhouse has outperformed Meta, Netflix, Amazon, and Apple. So this kind of goes to show, like Josh said, while we do own some of those big names, we also are able to own companies like Texas Roadhouse that have returned similar, if not better returns, but without the significant risk that those concentrated positions also have.
All right, so far we've only talked domestically. I know you guys are going to talk about my personal favorite slide and how clients invest overseas. Just to explain this slide while it's up on the screen, I think it's self-explanatory, but if you give it a second and think about it, inside that circle, there are more people living than all of the area outside that circle. So obviously you got China and India in that circle. Those are the 2 big drivers, Southeast Asia. Over the next 30 to 50 years, that circle is going to drift a little bit to my left. It's going to move towards Africa as population there grows, and you have some population declines in Asia. So we think that's an interesting visual on what's going on outside the United States. You guys talk about how that matters in our portfolio.
There's a saying that the US does not have a monopoly on quality businesses. Even though the US has been outperforming the international markets for a long period of time, which you'll see on the next slide, that tends to go in cycles. So from 2000 to 2010, you were better off investing outside the US versus in the US. And now in this long cycle where the US has been the better performer, but you haven't been hurt by investing outside the US. You just haven't had as strong of returns as the S&P 500. But we could be nearing the end of this cycle. It's been a long one, right? Almost 14 years where the US stock market has been the better performing market. But there's still so many opportunities outside the US, so many good investment opportunities. As much as people are excited about the Mag 7 in the US, there are 7 big tech darlings. There's stocks in Europe called the granola, which have actually outperformed our stocks. So they have high quality businesses. Colin can tell us what those granola stocks are. But the US is not the only place that quality companies exist. And diversification, again, if we can build portfolios that can be resilient if the US stock market doesn't cooperate, international stocks can often help us. So we do own stocks outside the US. We still own way more in the US versus outside, but we do have stocks outside the US. They do look much cheaper. So if you look at a US car manufacturer versus a Japanese car manufacturer, you're getting a better deal buying the Japanese company right now. So if we can find cheaper stocks outside the US, we like to do that and hopefully get better investment returns over a long period of time.
Granola is the European version of FANG. A lot of you might remember FANG. It was Facebook, Apple, Amazon, Netflix. So granola includes GSK, Roche, ASML, Nestle, Novartis, Novo Nordisk, L'Oreal, LVMH, Louis Vuitton to most people, AstraZeneca, SAP, and Sanofi. Clearly the acronym got a little expanded and they ran out of letters, but those are the companies represented in that pink line. All pretty household names. All right, the world's greatest investment, Colin, Bitcoin.
So Bitcoin and cryptocurrencies in general are something that we've spent tons of time looking at for years. And obviously this chart goes back to 2018. So Colin will tell you how many 40 and 80% downdrafts that Bitcoin has had.
Yeah. So we did run some numbers, and since 2011 is kind of when this asset class or Bitcoin emerged to most people. And there's been 10 drawdowns since 2011. The average loss is 63.5% on those drawdowns, which is almost double that of a stock market drawdown. So a stock market drawdown is right around 35% on average in a bear market. The Bitcoin cuts almost 63.5%. And on 2 of these 11 occasions, Bitcoin dropped over 50%, which cut in half within 1 week. And one of the times was within a singular day that Bitcoin cut in half. So there's a lot of risk within Bitcoin.
So when we look at investments, we really are trying to come up with some sort of valuation framework. So if you think about a checking account or a savings account, you can usually look at the bank and say they're going to give me a 3 or 4% yield. When you look at a stock, you look at the dividend it pays, you look at the earnings that the company has. If you look at a piece of real estate, you look at what kind of rental income that property is generating. You have some sort of valuation, home base, or framework you can use to try to figure out what it's worth. Bitcoin is one of those things that's really hard to value because it doesn't have any underlying cash flows. It's not based on any sort of tangible asset. It doesn't have an underlying business that's generating cash. So it's really a speculative investment in our view. And in some ways, digital gold is probably the better way to think about it. So gold doesn't really produce a cash flow. Gold has some industrial use. But gold has had a value for a long period of time. It's been a store of value. People continue to buy gold. We own a little bit of gold, but gold has no dividend and it's hard to value it. But in our view, the volatility profile of Bitcoin is so high that if you're looking at it, you would be expecting 30, 40, 50% returns to own something this volatile. I can't come up with a reason why Bitcoin reliably should go up by 30 or 40% every year. But a lot of smart people believe in Bitcoin. I don't think people are crazy if they put a little bit of their money in Bitcoin. For the last 6 or 7 years, I've told people I would avoid all the other cryptocurrencies. And if you want to own something, own a little bit of Bitcoin, keep it under 5% of your investments. I don't personally own any Bitcoin. I've had a Coinbase account. I've looked at cryptocurrencies. I've traded them a little bit just to see how it works. It's hard for me to believe Bitcoin is being used 20 or 30 years from now. What's to stop Bitcoin 2.0? What about quantum computing? There's all these risks to Bitcoin. But I wouldn't be surprised if it continues to do well. President Trump has kind of cozied up with the Bitcoin community. So I think you're probably going to have a little bit of a speculative frenzy for a while. But I would just caution people against putting more than 5% of your money in Bitcoin, and that just know it's super volatile. And I think a lot of people don't really understand what it is, but they see that it's gone up in price, so they want to own it. That's never a recipe for successful investing. So I would just approach this with caution. The next slide that you'll see is the proponents of Bitcoin often are worried about fiat currencies and the dollar. They think that most major governments are spending too much money. They don't want the government controlling their finances. They want to have a decentralized finance system. And I sympathize with a lot of that. I think there's better ways to hedge your risk against fiat currencies than cryptocurrencies. I think you can own real assets, you can own real estate, you can own gold, which has a longer track record and more entrenched use by central banks. This chart shows how correlated Bitcoin has been with the leveraged tech stocks. So it's looked and felt a lot like just owning a very leveraged portfolio of US tech companies. So if we do have, we talked about the Mag 7 being concentrated. If we do have any hiccups in the market like we did in 2022, you could see Bitcoin trading a lot like those tech stocks. So Bitcoin is relatively complicated. There's white papers that folks can read about it. We don't own Bitcoin in our client portfolios, but there are companies heavily involved in cryptocurrencies that are in the S&P 500. So if you own a diversified basket of stocks, you have some essentially, exposure to Bitcoin. So if you own NVIDIA or a big tech company that makes money off of the ecosystem of Bitcoin, you are somewhat participating, but more of like a picks and shovels approach, where you're owning a business that actually makes something, collecting earnings off that, and not necessarily owning the actual cryptocurrency itself.
Yeah, I think a good way to look at it is kind of view it as what is your goal, and do you need Bitcoin to help you reach that goal? So it kind of goes back to like redefining risk, and the risk in our financial plan is that we don't reach our long-term goals. So do we need Bitcoin to kind of help reach that long-term goal? We don't think so here at Frazier Financial. I think that's a good question to ask prior to purchasing any Bitcoin, because it does have a lot of inherent risk in it.
The last comment I'll make on Bitcoin, and then we have some questions. We talk to clients a lot about financial FOMO. So just to address the feeling around Bitcoin and cryptocurrencies, it feels like if you don't own it, you're missing out. So we have clients talk to us really about essentially feeling FOMO. So that's a very normal feeling if you have it. As Josh said, you just want to keep these to very small percentages of your investments and not get caught up in the gold rush. There's always an exciting gold rush out there. Years ago, it was weed stocks, and then it was AMC and memes and all kinds of crazy investing in 2021. And lately, it's Bitcoin and cryptocurrencies. The new one is Trump. We didn't mention the Trump coin.
Trump and Melania have their own cryptocurrency now.
We would not advise people invest in those highly speculative assets, but it's just going to keep making headlines. We had some questions come in, so I'm going to take you guys back to some of our concentration slides.
Yeah, just last thing on Bitcoin. We can own Bitcoin in client accounts. So it's not like we can't do it. And as a fiduciary advisor, we have access to pretty much everything that exists, given what we're independent. So we can buy it. And so it's not like we're prohibited, so we're just saying we don't like it. We have access to it. We easily could buy it. We just don't think it's the best thing to invest in. We just think there's too many other things that have a little more reliable return stream.
We got a really good question on Bitcoin before we go back to concentration. Someone asked, is it a synthetic currency? Because they do get called cryptocurrencies. Can you just riff on that for a second?
Yeah, like the image we just showed, actually shows a physical image of what looks like it's a coin, but it's not a coin. There are no physical coins. It's really not a currency.
It's not stable.
Yeah, it's volatile. So I wouldn't really think of it as a currency. Currencies are stable. Currencies are actually easy to transact. The Bitcoin ecosystem is actually very energy intensive to transact on, and in the Bitcoin world does not actually have the ability to handle all the transactions that people would need to use if everybody was using Bitcoin. So it's more of a store of value, hopefully, or a speculative asset, and less something that we're all going to be potentially using as a currency. That wouldn't actually work very well.
The IRS calls it a digital asset, for example. All of you, where we do your tax return, you answer that question every year. Do you own digital assets? That's probably a better term than currency. The Q&A that came in around concentration, we can jump back. So Colin or Josh, can you talk about trajectory? That red line is 2024. And there's been a little bit of broadening. What does the future look like, do you think?
If we go back through history and you look at the 10 or 5 or 10 biggest stocks, it's almost with clockwork that the next 5 years, all those names are different, or most of them are different. So 10 years ago, those were not the same biggest stocks that we have today. So 10 years from today, it's likely we'll have 1 or 2 of those probably persist. So if you own more of a concentrated position in those, you can just expose yourself to more risk if they don't deliver. Whereas if you have a more diversified portfolio, you're just not nearly as exposed to them disappointing. I'm not sure they answer your question.
Yeah, and I'll read the question specifically, or a similar question. Are we at greater risk of volatility with a high concentration of the stock market in fewer companies' hands? I think generally we'd say yes. You guys want to expand on that?
Yeah, generally, yes. Now, if you have if those 10 biggest stocks are not volatile, say they're all like really boring companies like Procter and Gamble or Walmart that have stable share prices, I would say maybe it wouldn't make the whole index more volatile. But NVIDIA has definitely been more of a volatile company because their earnings have been growing so rapidly. But when they report earnings, their share price can be down 20%. With these other big tech companies. So I think that these stocks are a little bit more volatile than the overall market.
I would also put in there, as Josh mentioned earlier, we don't predict, but we do prepare. So our active managed fund that we have in the portfolio, they don't have to own these positions. Or if they do own them, they can own them at a lesser weight. So if one of our funds thinks that these positions are overvalued, which many of them do, they might own them at a lesser weight and kind of find those more cheaper stocks like Texas Roadhouse that can perform as good, if not better than on an annualized basis without the same risk that these positions do have. And there are some statistics going back to 1964 and 1999. You see a little bit of a bump there in the 70s. Most of the time, when markets are concentrated, those positions on a 3 and 5 year rolling basis are negative. So not saying that that's going to happen with these companies because, as Josh mentioned, these are good companies, but that does not mean that they're good investments over the next 3 to 5 or 10 years. So,
and like Apple being a 7+% weight in the S&P. Well, I'm not saying own zero. We don't own zero, but maybe own less than 7%. Diversify yourself a little bit.
There's certainly more risk in indexing. We haven't really mentioned that, but an index fund is a lot different today than 2010. So
which we like. We do like index funds, but we like it when they're more diversified. The index fund is meant to be super diversified. There's actually rules about concentration risk, and these index funds now have bumped up against rules like they're too concentrated, but it's not really their fault. They're just responding to what the market is saying. But when people invented the S&P 500, they didn't really want it to be 30 or 40% in a handful of companies.
While we're on this slide, another question from our friend Ali. Will AI be the disruptor that breaks up the top 5 or the fuel that consolidates or accelerates concentration?
So far, it's contributed to concentration. I think when you go through these cycles of new technology where it's the companies that are on the forefront initially benefit, and then as the use cases broaden out the economy, other companies start to use that tech. So if you think about artificial intelligence, right now it's the companies that are developing the algorithms, that it's the companies that are building the data centers that are facilitating this. But eventually it will be your Home Depots and Delta Airlines that actually get to implement this in their businesses and improve their businesses. So we're at the start of AI right now, where if you put AI in the name of your company, you're probably going to see your share price go up 30%. But 5 years from now, we're probably just going to see a nice broadening out. I also, and I'm not an expert in AI, but we look at it a lot from an investing standpoint. We look at it, can we use AI to make investment decisions? And there are funds out there that have been around for years now that basically said, hey, algorithms and AI, you pick stocks. You say, should we own Apple or Google? And those funds haven't beat the market. It's very, very hard for AI to try to predict what's going to happen in the markets and pick stocks. So I don't think AI is going to be doing a great job picking stocks anytime soon. But yeah, that broadening out would likely benefit other stocks that aren't pure AI companies right now, is my guess.
Going back to international, we had this slide talking about this cyclicality between domestic outperforming international. And we had my favorite slide on the demographics of Asia. So the question that came in is here. How do you view Chinese and Russian stocks? A lot of political noise in both of those countries and a shooting war in one of them.
One last thing on AI before we answer this question. What it seems to me is like AI is extremely competitive. There's a bunch of companies that have AI, a bunch of companies that have AI solutions right now. So I don't really see necessarily what's the huge moat around their business. So that's probably a good thing and probably will cause concentration and not persist, because it's not like the iPhone where somebody comes out with a product and has a big share of the market and nobody else is able to compete with them. There are so many venture capital investments being funded right now that look at AI. The US is not the only company. We are the leader. And there's hundreds or thousands of companies working on AI right now. So I think it is primed for disruption, and that's probably a good thing for consumers and businesses, but it maybe helps with the whole concentration risk not persisting. Okay, so on Russia, after the invasion, our government basically said you can't buy Russian stocks anymore. Russia made up a very small percentage of most indexes, so wasn't super disruptive to us or our clients. But yeah, you really can't buy Russian stocks right now. So that's really not an opportunity.
China?
China looks extremely cheap. So their stocks are way down. Their economy is struggling. We have not been rushing in to buy Chinese companies, even though they look cheap. We own less Chinese stocks than most investors do. So if you just look at like a target date fund or kind of a set it, forget it option that would be in your 401k, we own a little less Chinese companies, but we do own some. There's still some good businesses in Hong Kong. There's still some Chinese stocks that are doing great. So in a little bit, but there's just a big risk overhang. It is ironic though. I mean, I have clients who are worried about China. They want to put all their money in the S&P 500. Then you look at Apple, tremendous China exposure. Nike, tremendous China exposure. General Motors, all these big US companies have China risk. Colin, what do you think?
Yeah, no, I agree. I think, like Josh said, there is a lot of really cheap companies within China. The political uncertainty has kind of outweighed any investability within the country. So while we do have some position in China, like Josh said, we are underweight compared to the average investor. So there was in quarter 3, there was some kind of hope, and Chinese markets ran up a decent amount last year. That proved to be a little bit of an overreaction, and it's simmered out a little bit. The Chinese government is trying to implement policies to kind of get an economic turnaround. And you have seen some growth within China. But again, that political uncertainty is kind of that major headwind within that region. So
we, for like over 15 years, tried to access the Chinese consumer by US or European listed companies. So Louis Vuitton sells a lot of things in China, but based in Europe. So you don't have to buy Chinese stocks.
We have another good question that dovetails nicely. Someone asked, do markets seem more insulated from geopolitical risk? We have wars in Ukraine and the Middle East, and they have not had much impact. I think that's a good point. You haven't had big market downswings with these pretty large regional conflicts. Think that's new, or is it because the United States is not involved? Other factors?
I think it's because the US is relatively energy independent. So when we had a war in the Middle East in the 90s, that would cause major disruptions to the oil prices. You would have lines at gas stations in the US. Now the US produces so much of our own energy that it's not as disruptive to our economy when wars break out in the Middle East. I think that's part of it.
We got another good question here. It's a little bit of a long one. I'll read it here. Some investment firms are forecasting higher returns in bonds and stocks over the next 10 years. Would you recommend an overweight to bonds given the potential return with lower volatility, like a 55-45 instead of the old 60-40?
So we have more bonds in our portfolio than by 1% or 2 probably than what we did, several years ago. So I would say we're overweight bonds in a lot of cases. I still think there's a lot of opportunity in stocks, and from a tax efficiency standpoint, if your taxable accounts, stocks have a little better tax treatment than a bond fund. So if you look at taxes, you still probably want to own some more stocks. But if say you're taking 4% of your portfolio every year as a withdrawal, and you got 40% in bonds, that's 10 years of draws that you have protected in the bond market. And the bond market does have a little, ups and downs, but not near what the stock market does. So that money that you need the next 5 or 10 years is in stocks, it's in bonds and cash. And then the money that you don't need for more than 10 years is in stocks. So I do think, returns could be a little higher in bonds than what we've had in the past, but I still think stocks could do okay.
Just a reminder to everybody on the call, we've got about 5 minutes left, and we've got a lot of questions coming in. So please keep typing those in. A reminder that you're going to be on mute. So Q&A is at the bottom of your screen. You can click that Q&A box, type in any questions you'd like to. We have a client who asked if you could discuss concentration risks in the healthcare sector. If you guys can A little granular.
I'm guessing that question is around like the GLP-1 drugs. It's just a guess. Yeah, the Wegovy's and the Ozempics have been huge money makers. A lot of people are taking those medications to help lose weight or improve health outcomes. So, I mean, those stocks have definitely done well. We own some of them. They're in the market indexes. I think they probably, I get scared about potential side effects and issues down the road anytime a new medicine comes out. So I'm not saying we don't own them. We own some of them, but for all that good news to continue, it's possible for sure. I mean, maybe these are the wonder drugs that we think they are, but I always want to be a little more cautious on that. We do get healthcare questions around the US and RFK being in the Trump administration. So the healthcare stocks in general have kind of not done as well as the rest of the market since the election. So I think that could be one of the reasons why, is people are just worried, what's RFK going to do?
One of the highlights of the last year or so has been gold. We haven't touched on that. So I'll ask you guys to talk through. This is a fund that nearly every Frazier financial client has owned for 15 or 20 years, something like that. They do have an allocation to gold. I think gold's kind of a hot item in the news. You guys do a 2-minute riff on First Eagle.
Don't you do that, Brian? You love this fund.
I do love this fund.
You've been investing your clients in this for 15 years?
Yeah, there's some people on the call that worked with me at PNC. First Eagle was a strategy I used at PNC because Jim and Josh Frazier highly encouraged me to do that. First Eagle is a very active manager, so it's kind of the anti-indexer. They can buy nearly any security or commodity, really, anywhere in the world. So lots of currencies and countries. They have a pretty big slug of gold. They own bullion, so those are gold bars with their name on it in a vault. They also own a fair amount of gold mining companies. And so this is just something that's a lot different than a traditional off-the-shelf portfolio that you might get at a bank or big headline investment firm. And so that slug of gold has been a big contributor to returns. And First Eagle also has this tendency to hold a lot of cash. They're very dedicated about only purchasing things they feel are selling at a discount. And if they can't find something at a discount, they are very happy to let their cash build up. And so throughout history, they have this tendency to get 5, 10, 15% cash, and then some sort of crisis occurs and you will watch their cash go down and they feel they're out there buying things at a good discount. So certainly a long hold from our time here and all the way back to Jim Frazier in his very early days investing in First Eagle. Anything to add there, Colin?
I would just emphasize that they are truly active managed. This is a truly active managed fund. And like Brian said, in periods where people think that stocks are overpriced or that the equity concentration is high, they don't have to purchase stocks. So if they do think stuff's expensive, they can kind of sit and wait. They don't have any mandate to any benchmark that they have to invest a certain percentage, and they can move up and down their gold allocation. And gold performed really well last year. It had double-digit returns that really helped this fund out. It really helped our clients really prove that diversification benefit of having that alternative asset commodity within this fund. So yeah, this is a great fund, truly active managed fund. They sit and wait for stuff to get cheap. They don't rush into anything. And that's proved to be very successful over the long time that we've held this fund. So,
and gold makes up a 1 or maybe 2% allocation for a whole portfolio.
Yeah.
So we talked a lot about today, but it's not a huge allocation. We think a little bit of gold goes a long way.
Yeah.
I'm getting compliments in our Q&A. That's unexpected.
It seems like this is our first webinar. It is.
Yeah. I think we'll make this our last question. And it goes back to Bitcoin, which is certainly where we got most of our questions today. What would have to change for us and maybe other investment advisors to feel like it's a suitable strategic investment?
Like Josh said, Bitcoin is likely here to stay. The cryptocurrencies at large are likely here to stay. To make it investable within a portfolio, it, like Josh mentioned too, it just doesn't have any cash flows. It doesn't have anything backing it, and it is very volatile. So the risk is very high. And as I mentioned, we kind of have to redefine what is your goal, and does Bitcoin help you reach that long-term goal in a portfolio? As of now, we don't think so. We don't believe so, but not saying that we will never have any allocation to Bitcoin or any funds within our portfolios will ever have any allocation to Bitcoin. As of now, we just think that a daily movement of 5, 10, sometimes 50% is just way too much to have in a portfolio long-term goal. So
Yeah, they say never. I think if it had more broad adoption from a central bank standpoint, that would be interesting to me. And if the volatility profile was a little lower, and if someone came up with a technology that would add some sort of like yield feature to Bitcoin, where you could own it but also earn a yield component, which some funds are actually starting to do that. So that could change our view on it.
Yeah, you can pledge currencies and get like a 5.5% yield. It's kind of intriguing.
and another thing is you've had a lot of talk about the US government having some sort of strategic Bitcoin reserve. Some statistics I found.
With what money, Colin? We're broke.
It's true. The US government actually does own 200,000 Bitcoins, which is worth north of $20 billion right now. So the US government does own some. That comes from criminal seizures. They don't buy it.
That's always a good sign, right?
Yes, yeah. So the government's not buying. They do own some. So
Does that sit on the balance sheet of the Fed? Seized Bitcoin?
yeah, somewhere in there.
Go look that up.
Yeah.
All right, well, we're at time, so we'll conclude the webinar. We really appreciate everybody being with us. And as Josh said, this is our first one. We'll be doing more of these. A lot of you have said you'd like to hear more about the markets. And so we'll set this up as something like a quarterly cadence. For those of you that attended today, we'll send a save the date. We're going to have a date in April for the next one. So we're going to go do all of your tax returns, and then we'll come back and talk about investing again. Really appreciate all of your faith and trust in Frazier Financial, and we'll look forward to seeing everybody soon.
Thank you.
Thanks.